on interest rates, if you look at a picture of two-year yields, okay, so two-year is pretty straightforward. I think, Ben, I think most people know that bond yields have been going up for 3 years now, but in particular, the two-year yield's been going up quite a bit this year, and that's mainly because we've been in quad 2. So when you're in quad 2, what happens is that the Fed sees that as hawkish and they raise interest rates. So the short end of the curve, the two-year yield, continues to go higher. That's mainly why I'm not long the two-year yield. Again, we're just predicting that the Fed is going to predict what already happened on a lag, okay? So we're getting the tail end of quad 2 data. Yesterday, what got this going, or what got the machines going rather, and it really was a huge technical move. And again, the machine matters. We're not going to blame the machine. We're just going to try to understand it. You had an ISM services number that had a 61, I think, in front of it, which was, I think that's a new high, isn't it, Ben? That's pretty close. Yeah, it is a new high, 61.60. So you had that. You had European bond yields start to go up, and then you get a move above the prior closing high for the 10-year yield, which goes all the way back to May. So unless the curve was ready to go fully inverted, the 10-year yield had to chase what the 2-year yield was doing. Don't forget that the 2-year yield only a couple days ago was 7-8 basis points lower, and only a day ago, the 10-year yield was at 305. So this morning when I got up, I think it was at like 323. If you don't think that that was the machine, again, the machine is constantly delta hedging, feeding off itself during and throughout and after a move, and then you get a capitulation. So I think that's what's happening here. It doesn't mean that I'm not wrong. I'm just trying to articulate why this is happening, and moreover, why there's another data point tomorrow that supports another hawkish outlook by people that have not understood that we've been in quad 2 for, again, 5 quarters in a row. We've been in quad 1 or 2 for 9 quarters in a row. So again, the bond market's been discounting us. The question is, when does it stop doing it? First, it does it slowly, then it does it all at once. Then it squeezes your brains out like it did yesterday, and then you need me to hold your hand. No. This is all part of a topping process. So in as much as the chart, and a lot of people will look at the 10-year yield and say, wow, it's a big breakup. If you go back to Q2, Q3 of 2016, you'd say that the 10-year yield was, oh, that's a terrible chart. That's a big breakdown. Precisely when you should have been shorting long-term bonds, when we were coming out of quad 3 and quad 4 and going into quad 2 and quad 1 for 9 quarters in a row. It's not easy. No part of this is easy, okay? For those of you who just started to buy bonds and this feels a little like crazy to you, well then, make it less crazy. If you use real-time alerts, for example, utilities yesterday in the morning when I first saw the move, I said, okay, I'll sell some of those. And I wrote explicitly why I thought 10-year yields could go higher, which is we do have another jobs report, which is pending tomorrow, where we're going to get wage inflation. Yes, I have some of you today saying, oh, but if you knew all that, then why'd you buy them to begin with? But then I have all of you who've been asking me to buy treasuries for the last 3 to 6 months. So again, the timing matters. And by the way, when I put it all on, I put it all on. So I'm still long dollars. Like I said, I'm still long the other side of what I think you should be in quad 4. So again, most of the things in quad 4 are working. The rates move obviously is not. I think we're ticking at 318 here, but the current risk range now, we're going to go to 3.00 to 3.23. So the best thing you can do, or the best thing I can do, and I'm not like max position, is operate within that risk range. That risk range changes daily. At 3.00, we know what we want to do. We want to be selling some bonds. In as much as at 3.23, we want to be buying bonds. That's the new range for the long bond. Again, this is an intermediate to long-term outlook. This is not a day trade. I understand yesterday's day trade was painful. Again, I'm not here to hold your hand or cry in your soup. I'm trying to help you understand why we're staying with it. Again, quad 4 data in Q4. The September numbers, which includes tomorrow's job number, is still quad 2 data, again, which is Q3, which is, of course, what was September. So we're talking about the comparative base effects. So for the fourth quarter, and then the first quarter, and the second quarter, 2.2, 2.25, 2.5. So the further you get out in time, don't forget that U.S. economic growth looks awesome right now because you're comparing against these. 1.9. Okay, that's it. We're talking about a material step up in terms of the base effects here, and look at it for inflation. I mean, this is a material step up. That picture is why we're getting long bonds and short growth. That's it. That's the number one picture. Next slide. You can see if that's not good enough in terms of the visual, that's just the math. Those are the base effects. Just look at it in terms of color coding. Okay, so this is showing you, again, it's showing you by line item in U.S. GDP, retail sales, industrial production, exports, factory orders, et cetera, et cetera, et cetera. The world, when everybody wanted to be long bonds, including us, and we got that right, was very red. Then it went, oh, better than red, to max green. All this data that you're seeing right now is called quad 2. If you bought bonds here and you sell bonds here, rather bond yields, if you shorted bonds right here, and now you're getting out of them right here, this is how long our call's been on that, okay? Now we're changing it. The reason why we're getting long bonds or long duration is because the green turns into a bunch of yellow. So again, from here to here, you want to be long-term bonds. When the rate of change goes from as green as you're going to get to mellow yellow, I don't know what I want to call that, but it's certainly not green. Now the alternative view is that this is going to stay green on your screen for as long as could persist. After the record run that we've never seen before, which is 9 quarters in a row of that accelerating. So again, that's one way to look at the heat map of all the different line items. And by the way, those numbers are all going to come out in October and November and December. In fact, they won't. If you're really worried about bond yields and how much higher they can go, A, they can go to 323 because that's the top end of the range. B, most of this data, the October data, is not going to be reported until November. But then there's this thing called Mr. Market that's constantly front-running you. So again, if you've been watching the show for a long time, most of your questions are trying to front-run me, who's trying to front-run the market. But today, you want to be like super right to the screws on this, right? I mean, and that's why I do it that way, because it's so damn hard to get the timing right. But it's really easy to get the bigger moves right once again, it becomes clearer and clearer to people that the world is going from a bright green light to something that's lime green and then yellow.
Yeah, and the other thing too is sticking with that quad process. I mean, the timing of when we're going to get the data hasn't changed much, right? Like any historical study, if we look at the GIP model, like what does well in different quadrants.
Right.
Like last year, we didn't get the October data until November either, right? It hasn't changed at all over a long time.
Right. No, but it's when you get a violent move like this, everybody's like, oh my God, how does this process work? It really gets down to the hardest part about this is not the GIP modeling view. It's the market timing signal. That's what makes this game very difficult. This is called a portfolio. The idea in a portfolio is to have asymmetry. So in other words, let's say you got 10 longs and 10 shorts. Hopefully you don't have 10 bond longs and 10, or no shorts. That's just stupid, okay? You want to have 3 or 4 bond proxies. You want to have 3 or 4 bond things. You want to have Brazil on the short side. You want to have EM on the short side. You want to have China on the short side. There's plenty of things. You want to have all of Europe on the short side. So if you're running a portfolio, you should have, the way to hedge any long position is to have a good short idea. And that's, to me, actually, like our shorts have never worked better. So hopefully, I haven't had any questions about that, of course, but I mean, that is what a portfolio should look like.
Well, we do have a comment here, actually, which I was going to say next. Thanks very much for the EEM and FXI puts. I threw in some Baidu as well.
Oh, cool.
What do you see for non-farm payrolls tomorrow with regards to emerging markets and 10-year yields? Thanks again.
Well, so non-farm, so in the early look note this morning, I go through it in detail. So again, I'm showing you the year-over-year base effect. Don't forget that last year in September, non-farm payrolls got hammered by Hurricane Harvey. Okay, so the year-over-year is like a demolished number. And yes, we could have talked about that every day up until now, but I think it would have bored your mind. And it doesn't really matter till the bond market says it matters. So tomorrow should be a super hawkish jobs number, if only because it's comparing against one of the biggest hurricanes in U.S. history. So again, that's the point. I'd expect that, like I said, the bond market expects it. I expect it. We've always expected labor to continue to go higher. Moreover, wages always go up into and throughout a recession. It's what perpetuates a recession. Think about it. If you run a company, you get it, right? You start paying your people as much as you ever have, and then your revenue's slow. You know what that does to your profits? Bingo. That's the profits start to decline. It feeds on itself. The recessionary fears start to mount, and you're on the backside, or as my dad would say, the wrong side of the grass.